Hello and welcome to this video. In this video, we are going to do a A-level question from paper 3, variant 31, May-June 2019, question 5, based on standard costing. The question states that G Limited manufactures a single product. The budgeted information for March 2019 is as follows. Sales and production, which is 8,000 units. Direct material per unit is 3 kilos at the rate of 5 per kilo. Direct labor per unit is 2 hours at the rate of 20 per hour. The total fixed overhead absorbed on the basis of direct labor hour were $128,000. The actual sales and production for March 2019 was 7,800 units. In the A bit of the question, we are asked to prepare a statement to show the total flex budgeted production cost for March 2019. Flexed budget or flexible budget depends on the actual level of activity, that is, it will depend on the actual level of sales and production, which is 7,800 units. And for this, we will require the unit cost, and the unit cost for direct material and direct labor is already given in the question. However, for overhead, it is given as the total fixed overhead cost, which is absorbed on the basis of direct labor hours. So for this, we need to find the overhead absorption rate, as fixed overheads do not depend on the production. It remains fixed for a period of time. So this is allocated on the basis of OAR, that is overhead absorption rate, and for this we are going to calculate the fixed overhead absorption rate per hour, which will be equal to the total fixed overhead, which is given here as $128,000, divided by the basis on which we are going to allocate, that is the direct labor hours. So the total direct labor hours required will be the total amount of units which we are producing is 8,000 units, and to produce 1 unit we require 2 labor hours. So the total direct labor hours will be 8,000 times 2, which will be 16,000. So once we calculate this, we will get the fixed overhead absorption rate per hour as $8, and again we require 2 labor hours, so it will be 2 times 8 for 1 unit. Then we are going to make the statement showing the total flex budgeted production cost for March 2019. We will start with the direct materials. Here the actual production is 7,800 units times 3 kilos, which is required, and the rate is 5 per kilo, so it will be 3 times 5, and we'll get the direct material as $117,000. Then direct labors, which is required here, the actual units produced and sold were 7,800 units times 2, which is the 2 hours which are required for 1 unit, times 20, which is the wage rate for the labor. So this will be equal to $312,000. Then we have fixed overhead, again the actual production, which is 7,000 units times 2, because we require the 2 labor hours, times 8, which is the overhead absorption rate for fixed overheads. So we'll get the value as $124,800. When we total this up, we will get the total budgeted production cost as $553,800. Furthermore, additional information is provided which states that the actual production cost for March 2019 were direct material for 21,840 kilos was $117,936. Direct labor for 16,380 hours was $335,790. Fixed overhead was $131,040. Total production cost was $584,766. In the B bit of the question, we are asked to calculate the following variances. First, material price variance. Variance is the difference between the budgeted or the standard cost minus the actual cost. Material price variance will be equal to the direct material, which is required here, is 21,840 kilos times the budgeted or the standard cost for material was $5 per kilo. So when we multiply this, we'll get the value as $109,200. From there, we will subtract the actual cost, which is $117,936, which will be equal to negative $8,736, which means it is an adverse variance. An adverse material price variance means that The budgeted material price was less when compared to the actual cost of material. It is due to the increase in the price of direct material since the budget was made, and this will increase the overall cost of production and will have a negative effect on the profit. Hence, it is an adverse variance. Then we have material usage. For material usage variance, we are going to take the number of units which are produced, which was 7,800 units, and for 1 unit we require 3 kilos. So we will multiply 3 kilos with 7,800 units. We will get 23,400 kilos of material requirement based on the budgeted estimation, and the actual production required 21,840 kilos of material. So when we subtract this, we'll get the value as 1,560 kilos, and we will multiply this with the material price, which is $5. We'll get the value as 7,800. Favorable variance. Favorable material usage variance means that the material is more efficiently used and there was less wastage of material, and hence in the actual production the material required was less, that is 21,840 kilos, when compared to the estimated or the budgeted material requirement, which was 23,400 kilos, and this will have a positive effect on the profit. Hence it is favorable variance. Then labor rate. Variance in labor rate is calculated by taking the total direct labor hours, which is 16,380 hours, times the labor rate based on the standard or the budgeted cost, which was $20 per hour. So when we multiply this, we'll get $327,600, and when we subtract the actual direct labor cost, which is $335,790, we'll get negative $8,190. Again, this is an adverse variance, which means that the wage rate paid to the laborers were more when compared to what was estimated, and this will have a negative effect on the profit. Hence it is an adverse variance. Then labor efficiency. Variance in labor efficiency is equals to 7,800, which was the units produced, and times 2, that is the number of labor hours required for producing one product. Will get the total labor hours based on the budgeted estimation as 15,600 hours, whereas the actual labor hours which was required was 16,380 hours. So when we subtract this, we will get a negative 780 hours, and we will multiply this with the labor rate, which was $20 per hour. We will get the value as negative 15,600 dollars, and this is an adverse labor efficiency variance, which means that laborers were less efficient, hence required more amount of labor hours to complete the work, and this will have a negative effect on the profit, and hence it is an adverse variance. Next, we have fixed overhead expenditure variance. Fixed overhead expenditure variance is the difference between the value of the main budgeted fixed overhead, which was given as $128,000, and the actual fixed overheads which was spent during the production, which is $131,040. So the variance in fixed overhead expenditure is equals to $128,000 minus $131,040. Will get a negative $3,040. This is an adverse variance, as the actual spending in the overheads was more when compared to what was estimated. Hence this will have a negative effect on the profit. Then we have fixed overhead volume variance. Volume is the quantity of your production, and the budgeted quantity of production was 8,000 units, and based on the total costing, we do not wait till the end of the year to find how much each product is absorbing the fixed overheads and then start selling the product. Based on total costing, we find the fixed overhead absorption rate, and we start selling the product by adding this rate of a fixed overhead to the cost and find the selling price. So when we estimated the budget, when we made the budget, we estimated that we are going to produce 8,000 units, and on this 8,000 units, the overhead which was absorbed was $8, which we calculated in the first bit of the question. This overhead was for 1 hour. This was per hour, and we have calculated this based on the direct labor, and we required 2 hours of direct labor to make 1 unit. Hence it will be 2 times 8, which will be 16, and this multiplied with the budgeted units which we thought we will produce was 8,000, so we will get $128,000. However, when the actual production was done, it was produced only we produced only 7,800 units, and for 7,800 units it will be 7,800 times 2 times 8, which will be $124,800. And because of this, that is because of the reduction in the production from 8,000 to 7,800, we were not able to produce this 200 units. And as we have not produced this 200 units, the fixed overhead for this 200 units was not absorbed. That is 200 times 2 times 8, that is $3,200 of fixed overhead was under absorbed or under recovered. And because of this, the overall profit will decrease, and hence it is an adverse variance. So when we calculate the variance in fixed overhead volume, we will take the value which we have calculated during the first or A bit of the question, where we made the flexible budget, and we take the value from the flexible budget for the fixed overhead and we will mention it, and from there we will subtract the value which was given in the question for the fixed overhead for 8,000 units, which was stated in the information in the A bit of the question. So once we do that, we will get the value as $3,200, which is an adverse variance. Next, we have to explain how a fixed overhead capacity variance may arise. Fixed overhead capacity variance is a subvariance of fixed overhead volume variance. It arises because of the difference between the actual hours worked. This may be the labor hours or the machine hours on the basis of which the overhead absorption rate was calculated and the hours absorbed. Based on the question which we are doing, the actual labor hours worked was 16,380 hours, whereas the labor hours which was absorbed on the basis of which the overhead absorption rate was calculated was 16,000 hours. This was the budgeted or the estimated hours, and because of the difference between these two, that is 16,380 and 16,000 hours, the variance which we calculate is called as fixed overhead capacity variance. Then in the debate of the question, we are asked to prepare a statement reconciling the budgeted production cost at 7,800 units with the actual production cost. For this reconciliation, I'll give you a simple example. Suppose you want to buy a phone for your mother and the cost was $230. Whereas when you went to the dealer, he said the actual cost is $248. So the difference between this 230 and 248 is the $18, which will be the adverse variance for you, because this will have an adverse effect on your savings. You have to pay $18 more. And the gift wrap for this was you estimated as $5, and whereas the actual cost was $2. So now this will be a favorable variance for you because you estimated 5 and now you will be able to get it in 2. So you will save $3 and this $3 will be your favorable variance. So your estimated budgeted cost for the phone was $230 plus 5, which was $235. Whereas the actual phone cost which you have paid was $248 plus 2, which is $250. So now from this $235 you have to come to $250. So how you will get that? You will take this $235 to this, you will add the adverse and you will subtract the favorable. So you will get the value as $250. In the same way, we will do the reconciliation based on the information which we already have in this question. That is, the budgeted production cost which we have is $553,800, and then we have material price variance, which is an adverse variance of $8,736. Material usage variance, which is $7,800 favorable. Then labor rate variance, which is an adverse variance of $8,190. Labor efficiency variance, which is an adverse variance of $15,600. Then we have fixed overhead expenditure variance, which is an adverse variance of $3,040. Then we have fixed overhead volume variance, which is again an adverse variance of $3,200. So we add all the adverse variances, we get the value as $38,766. From there we will subtract $7,800, which is the favorable variance. We will get the value as $30,966. We add this $30,966 to $553,800. We will get the value as $584,766, which was the actual production cost. Thus, we have reconciled the budgeted cost to the actual cost. Furthermore, additional information is provided. The directors of G Limited expected that the labor cost will increase by 10%. The effect of this will be to reduce the budgeted profit. In the EBIT of the question, we are asked to explain the directors one way in which they could minimize the effect of increase in the labor cost. I have stated three methods here. You can state any one of this. First is machinization, which reduces the labor force. That is, if they go for automation, naturally the number of labors required will be less, and as the number of labor required is less, hence the labor cost will be less, and this will have minimum effect on the profit. And increase selling price, that is, with the increase in selling price, the overall increase in the cost of production can be cancelled and will have minimum effect on the profit. And lastly, I have stated to improve the operational efficiency. This can be done by giving additional motivational factors like performance related pay or any other motivational activities like training, on the job training, of the job training, and because of this there will be reduction in the wastage and there will be more efficiency among the laborers, and because of this the labor cost can be reduced and will have the minimum effect on the profit. With this we have completed this question. Thanks for watching my videos and have a great life.